Good morning, good afternoon, good evening, everyone. Welcome to this final session of the Cannes Finance School. Really happy to see you all. So today is the fourth session of a very intense and packed week where we're going to dive into specific private instruments and mechanism, namely ESG and taxonomy frameworks and securitization and insurance. But just before we go into the content, I just want to recap maybe and talk you through what happened earlier this week in case you were not able to join. So as you may know, we are proposing a curriculum style learning journey that builds progressively across the cycle. And this first edition is really focusing on private finance and what it means for climate action. So we started the week on Monday with a session trying to understand better the broader political and economic context. So discussing notions such as the Wall Street consensus, investable development paradigm, the de-risking logic, and really trying to unpack how current finance, how private sector first approaches shape the climate debate. Then we pivot to looking at how the international financial architecture and its institution are driving the private finance conversation and how all the instruments that we'll be discussing today and that we discussed on Wednesday are embedded in this broader system that is deeply rigged against developing countries. Session 3 that happened last Wednesday deep dive on already some specific instruments that are more and more used in the context of the private finance discussion for climate action. So we looked specifically at blended finance and public-private partnerships. So before I will give you a quick recap of what happened on Wednesday, I just also want to give a heads up to the participants that after the school closed, sadly today, we're going to organize an after school discussion where we want really to give you the floor and hear from concrete example and practices you have with private sector, depending on the region you base, on the thematic you work on, and really pivot toward more advocacy and campaigning conversation. So just a quick recap from the Wednesday discussion. So I won't do justice of the very rich discussions we had, but just give you some glimpse to give you maybe some appetite to watch the recording. So first, Maria Jose and Farwa really gave us really useful definition of the two instruments. That's the first thing needed when you want to unpack the concept. So we heard about their main characteristic, how they function in practice, what are the key issues with those instruments. So for example, Farwa spoke about the three fallacies of blended finance. So from the fact that there is no shared definition, no real additionality in practice, and that leverage ratios are often inconsistent and unregulated. Then we discussed also about the hidden costs of those instruments. So blended finance could actually be better understood as a direct fiscal cost or even a subsidy and not necessarily as a leverage. And so, of course, the term blended finance sounds innovative and efficient and is often promoted by many governments, but is actually obscuring a range of hidden costs borne by the public. Similarly, PPPs are actually the most expensive method of financing, often costing up twice as much as government borrowing. We also discussed how those instruments can be problematic from a climate justice perspective, and that both blended finance and PPPs involve transfers of risk and responsibility from the public sector to private companies. And we discussed specifically an example of coal retirement, and that's really reflecting that perverse logic, but also the fact that profits flow often from north and risk stay in south. So most private actors investing in blended finance are overwhelmingly based in the global north, and that's where the profits ultimately go. PPPs similarly secure profit and continue the extraction of wealth from south to north. And of course, that's even worse when you look at the deepening ongoing war, geopolitical context, and extremely indebted countries that are becoming even more insecure and vulnerable. And finally, we had a very interesting discussion about safeguards, because obviously, if those instruments are to happen, multiple safeguards would need to be in place. And we had a discussion, we listed them, etc. But then there was also an important question about we can't look at those instruments as a standalone issues, right? And so the question of safeguards require us to interrogate deeper the entire system that those instruments are part of. And that's also reflecting to the discussion we had in earlier sessions, right? So when we think about safeguard, the question is also who delivers them and how they're implemented on the ground. Because ultimately, those two instruments, whether it's blended finance or PPPs, are vehicles of speculative profit making, and they're designed to make projects bankable and profitable. And safeguards will not fix that fundamental purpose. So we also have to be mindful not to look at project by project and building safeguards for those, but actually keeping in mind the more structural reform and transformation we need to see happen. And Farwa really spoke specifically about not only focusing on specific project and instruments, but also look at alternatives that are actually already working on the ground, from regional trade blocks, South-South cooperation, public-led financing model. So now pivoting to today's session and what to expect from it. So similar to the approach we took on Wednesday and looking at specific instruments, today we really wanted to take the time to look at other mechanisms and instruments that are more and more present in the private finance discussion when it comes to climate action. So ESG framework and green taxonomies, the question of securitization and insurance. So beneath those technical discussion, we really have a shared political question to ask ourselves, right? Who benefits, who carries the risk, and who gets to define the rules? So we have amazing speakers with us today that will help us to navigate this conversation. They will be introduced in a minute. I'll just wrap up by reminding you how you can participate to the discussion. There are two ways to do so. One is simple. You just use the Q&A box and you can type your question, but also your reflection, your comments. Everything is welcome. We won't have the time to take all of them in the Q&A moment, but we will make sure that we capture them and insert them in the toolkit to feed into future discussion. The other way, and today is the day, I will be circulating a survey to get, of course, your feedback on the school, but also most importantly, to get your opinion on how to move the discussion forward. I was referring to the after school, that's one thing, but also for potential input on the next topic for the next school that would happen in September. So all that will come your way. So please keep that in mind and make sure you engage so that we can continue the conversation together. Without further ado, I will now hand over to my colleagues, Ali Akaje from 350 Africa and Berta Aguerta from Eurodat to lead us in the following part of the discussion. Thanks.
Thanks so much, Rebecca. I have the pleasure of introducing our two speakers. The first will be Miriam van der Stichler, an associate from the Transnational Institute. Miriam has been a senior researcher at the Amsterdam-based SOMO, S-O-M-O, the Center for Research on Multinational Corporations, focusing on the financial sector for about 20 years. She is a long-standing associate at the Transnational Institute, and she researches various functions of the financial industry and its impact on climate change, social issues, and public interest. She has monitored and engaged on these issues at national, EU, and global policy and regulatory levels, including with colleagues of the Global South, and she analyzes ongoing financial decision-making and supports civil society advocacy. Recently, she focuses on negative impacts of the investment industry. Our second speaker will be Advait Arun, Senior Associate for Capital Markets at the Center for Public Enterprise. Advait is the Senior Associate for Capital Markets at the Center for Public Enterprise, which is a non-profit think tank and consulting organization supporting state and local governments across the United States with developing and financing clean energy, climate infrastructure, mixed income, multifamily housing, and mass transit. His work focuses on identifying the policy and market barriers to mobilizing capital towards investments in these sectors. He formerly worked for the United States Treasury Department's Office of Sustainable Infrastructure, where he supported the implementation of the Just Energy Transition Partnerships. He writes publicly on the shifting political economy landscape of climate finance. With that said, Miriam, I hand over to you. Thank you very much.
Yes, thank you very much for the nice introduction. I will share my screen, which I hope will work. You can see my screen, I suppose.
Yes.
All right. Okay. So yes, I will look at some more of the instruments that are being used, I would say, to nudge the financial sector. But I also want to start a little bit also with the kind of some analysis of why we're talking about it. So, why is there a problem? Why are we talking about the Wall Street consensus and therefore PPPs, blended finance, and also indeed all the instruments that we will talk about today. So it's kind of guiding the financial industry. So taxonomies, different ESG instruments, not all of them, and something about green bonds. But I also will, in between, I will also mention some of the important international official agencies in the international architecture, which are not being mentioned, I think, in the previous sessions. Central banks, also how they are setting the banking standards and the laws. But of course, there also quite, as we know, is a huge amount of financial sector lobbying happening. And I will mention some of them because they are my biggest enemies. I hope you see my slide moving.
Yes, we do, but it's not in slideshow. If you could
No,
perhaps.
and I haven't been able to find out how, which unfortunately I didn't check before. So I think it's better that I continue like this. The only thing I want to say is, what we're really talking about is that the banks continue to loan to all kind of fossil fuel industries, let alone basically all the industry is still fossil fuel based. So we are talking about 7.9 trillion of fossil fuel financing since the Paris Agreement. Then, of course, you have also the investments going into the fossil fuel industry. By now, we have about 5.8 trillion going to that, to the coal and the gas and the oil industry, which are huge amounts. The thing is, what is very often not looked at is, of course, it is because these oil industry and fossil fuel industry is still making a lot of profits. It's not only about the profits, but it's also about the fact that they are paying out dividends. So they're paying out their profits in dividends, and they also in the form of paying back their shares, by which actually the value of their shares go up. They are able to, and then the ones who are benefiting from them is the investors. And those who are managing these investors are these kind of very large large asset managers you might have heard about, BlackRock, Vanguard, State Street, Global Advisors. They are the ones who are steering and who are pushing for the highest profits, and they're still being found for them, for the moment, still in the fossil fuel industry. And I just wanted to say this, because these are very important private financial players who are blocking what we really are trying to do, and why actually the instruments that we're mentioning are not really very working. It's not that the financial authorities don't know. The central banks have gathered together, and there are 150 of them from 95 countries in what is called the Network on Greening the Financial Sector. And they have made all kinds of scenarios, and basically they're saying we are now in a hothouse scenario by which the current policies will lead to 3 degrees. That means that a lot of financial instruments and shares and loans will not be being able to repay it. So this is a financial stability risk, and that's their mandate. So they're warning about, there is a problem, but still, we still don't have so much green, or not at all enough green financing. And basically that is because even these financial authorities, they're not able to set the rules. There are no legal obligations for the private sector to finance Paris-aligned corporate activities and projects, or even governmental ones. We will talk about the definitions and why that is, but the international financial architecture, you talked about the World Bank, IMF, and so on. They're not regulating by an international treaty. They're just setting standards. And for the banks, the biggest standard setting body is the Basel Committee on Banking Supervisions. They are the ones who are able to set international standards, which can become national laws. unfortunately, the US for the moment is very much blocking anything that they want to do on green. I mean, there are lots of details, but I won't go into it. And the other issue is there's still a neoliberal consensus that, let the market do what they want. And of course, there's a huge amount of lobbying. And the biggest lobbyist that is not being well known is the Institute of International Finance. I can tell you lots of stories about this. So basically what we have is we have only instruments that are nudging, but they're not really kind of standards and obligations to do so. So basically, I'm always saying there's two different worlds. We look at the left, how do the warming up is happening. The financial sector is looking at how the financial values goes up. So what is done happening, because there are no rules, we have some nudging instruments. And first of all, you need, even for PPPs and blended finance, how do you know it's green? And therefore, you have definitions that have been developed. It's called taxonomies, which I will talk about. Then you have many countries have introduced them, but also other ESG instruments or kind of green bonds standards. But most of them are not compulsory. Even if there is an EU taxonomy law, it's not compulsory to apply it. So most of them are voluntary and especially industry-led, or it's just greenwashing. It's just fraudulent. What, of course, is important that everywhere, even if governments are starting these instruments and they're kind of even regulating them as standards, as codes, as laws, it's the financial authorities who look at, how far this will really attract money and not being able to be too costly. And of course, lots of lobbying happening. And I've been seeing these procedures, and it's very difficult for civil society to come in. So on taxonomies, I only want to talk about the green taxonomy, but of course I just wanted to mention there are different kind of names for it. You have climate taxonomies, but you also have sustainable taxonomies, which are combining social and environmental. You even have a gender taxonomy, achieving gender-related goals like non-discrimination in boards, whatever. The important one is there is not really a dirty or what is called a polluting taxonomy. So there is not a good definition of what should not be financed. It's sometimes some taxonomies mention what should not be financed, but they're very little. And actually, Urgewald has itself being able to finance, to have some exclusion categories, as you might know, the global coal exit list or the global coal and gas exit list. So it's possible. It's not just officially not done because it's taboo, actually. So a green taxonomy means you categorize, it's a classification, it's a definition that is clarifying what is supposed to be green, and it can be very detailed in some particular instances. So the importance is, what is it wants to achieve, and that's what it is upfront. What do we want to achieve? Climate change mitigation, adaptation, transition to a circular economy, protection of biodiversity. These are kind of different objectives. And I mentioned the EU one because that's the first one, and it has been adopted quite a lot of the work in the world, not only adopted, but very much also adapted. So in the sense of looking at what is good for particular regions. So you have around the world, you have many of them. Like I give just an example of Brazil and Ghana, or of ASEAN. So they also have different objectives, very often also much better on social, including social aspects as well, because of course those two are combined. And they can be very prescriptive, these taxonomies, or they can be principle-based. And the principles are, there are some details there, but I don't think I can go into detail. But for instance, they have to significantly contribute at least to the objective, or they do not have to do significant harm to the other objectives. And then they can be also very prescriptive and have technical requirements like being science-based, saying when it has to be achieved, how much emissions are allowed or not at all, etc. And of course, depending on whether it's very descriptive, because some of these descriptions can take 4 or 5 pages per activity. For instance, if you say we want to build an activity is building a windmill park, that can take quite some pages to describe what is really meant and what should be achieved. And depending on whether it's prescriptive or not, you will be able to really achieve the taxonomy objective. The thing is, of course, it's more expensive. And the whole problem of the financial system now is that it is more expensive to finance green than to finance dirty. If you are financing something in the fossil fuels, you don't need to have a taxonomy that describes how dirty you are. You only have, when you are going for green, you have to have all kind of mechanism to show that you're going for green.
That's 10 minutes, Mariam. Thank you. You have a few more minutes.
Yeah. So then the second one is these ESG instruments where you don't, and I think the important is there is no clear definition of it, but you have to make a difference between ESG risks and ESG impacts. So if they're talking about ESG risks, that means it's a risk. The climate change is a risk for the financial value, while the ESG impact is about, it's not only about how the financial value is going down, but also that it has an impact, on society, on climate, and whatever. So the only thing I really wanted to, there's kind of, because there's no definitions, that it's all covering all kind of different issues on environment and social and governance. And the problem is that the ESG ratings also have these very dubious definitions, and you really have to find out what is happening and how they are rating. For instance, it's only best in class, which would mean, it's only an oil company. Shell can be the best in class, but it's still an oil company. So it's really, these products are really kind of, can be very much used for greenwashing as well. And rather than regulating what the rating should do, what has happened is that the regulators and the authorities have only made rules for the ESG rating providers, and I give some names there. And that's being also started at the international level by an international standard setting body for investors, IOSCO, which I think is an important player in the whole financial architecture. The green bonds, I just want to say, they are only 2 to 3% of the global bond market, just to give you an idea how small these issues are. And you have a green bond regulation, for instance, by law, which says you have to use a taxonomy. And then you can say you are an EU green bond, but most of the bonds are not by the Climate Bond Initiative, are industry standards, and it's by the International Capital Markets Association. If there's somebody you have to have in mind on who is your adversary, this is the one, because they have developed these green bond principles which are weak on what it really should finance, only to make sure that it is, those financings are being put in a pot, that you make sure that's for what the purpose is, but the purpose might be very weak. And these sustainability linked bonds are controversial because it's only at the end that you have to prove that you improved your impact, and therefore you can have a bit of more money. So my conclusion would be, the whole system is that this private finance is only putting money, one only talks about putting money in, but as previously has been also in the previous sessions, the private sector is about getting money out. You want to have high returns. And once you put these so-called externalities, so climate, social issues, into the mix, the returns are not so high. And that's why you have always this very little uptake of the financial instruments. And that's also why you have then kind of all these lobbyists going against it, because they have a huge expectation of high income, and they are fearing that it is not going to happen. So I just want to end there to say, kind of trying to explain, yes, there are these instruments, but we know that they are very little effect for the moment, and that's, the whole system is absolutely still not regulated, and that would be therefore a real issue. If we don't regulate, it will not happen. Nothing will happen. And of course, there might also be bottom-up instruments from civil society, from communities that might have kind of much better impact. If you want some more reading and technicalities, there we are. Thank you very much. I hope this have explained quickly something that we can hopefully also have more questions afterwards. Thank you.
Wonderful. Thank you so much, Miriam. We do have the Q&A box if you have questions as we go. Advait, over to you. Thank you.
Hello, everyone. Thanks so much for having me. I'm going to see if I can share my slides because it wasn't working earlier, but I think it should be all right if I do. Um, Perfect. I think everyone can see my slides right now, and we're going to go forward from here. Um, I'm Advait. I'm the Senior Associate for Capital Markets at the Center for Public Enterprise. A lot of my work is on supporting the United States development finance ecosystem for green projects, but previously I used to work at the US Treasury Department on the Just Energy Transition Partnerships, which were partnerships that the US and other global North countries put together to channel and mobilize private capital for projects across countries in Indonesia, Vietnam, South Africa were the main ones. Um, I have a lot of observations about the implementation or the lack thereof of this kind of program, some of the issues institutionally, some of the issues financially. I'm happy to talk a little bit more about that later. But my presentation today will be a little bit about just securitization and insurance, which are two mechanisms that I understand we have not yet discussed for the school, but would be happy to go into at a higher level of detail. So yeah, I generally write a lot about the struggles and issues with mobilizing private capital and depending solely on private finance as our solution for an energy transition. And that's where a lot of my interests come into this. I'll briefly start with just mentioning the Wall Street consensus. I know we've talked a little bit about some of these issues of why it's problematic to always rely on private capital, but I'll just summarize it myself and I understand it as the assetization of development, where infrastructure projects, energy projects, projects that are very much public goods essential for global well-being are tried to, well, where policymakers try to turn them into assets that the private sector can pick up. For various different political and economic reasons, policymakers think that it's useful for private investors to take on the burden of investing in these projects. And what that means is they need to generate some cash that investors, especially in the global north, are comfortable at a level of returns that global north investors are comfortable with. I have, there are many ways to, I think, blur the line between public and private support for projects in this space, but that's the kind of policymaking push beneath all of it. So let's talk first about securitization. So securitization and the development finance world's sort of embrace of this concept comes out of a very specific problem that the World Bank and the multilateral development banks have. According to a lot of the leading shareholders of the World Bank and the MDBs, these institutions have limited lending headroom. What that means is, given the debt that they've already taken on and given the loans they've already issued to various borrowing countries, especially across the global south, these banks, the multilaterals, are facing leverage ratio caps or liability caps. There's a limit to the amount of debt they're able to take on relative to the amount of money they already have from their leading shareholders, countries like the US, Japan, Germany, China, etc. So the lenders, especially the leading ones, or rather the shareholders, want to keep leverage ratios under the cap so that they don't suffer from a lower credit rating or don't suffer from higher interest rates on their loans. The credit rating agencies rate the World Bank, they rate the other MDBs, and otherwise, the more debt you take on, sometimes the more risky your future loans are. So what the policymakers are really trying to avoid is a situation where the World Bank lends too much and suffers for it. Their solution is securitizing their balance sheet, which really means selling the liabilities that they have to other investors, to private investors, to increase their lending headroom. And when I mean selling a liability, just to take a very abstract example, India is one of the largest borrowers from the World Bank. The World Bank provides a loan to India. India will pay back the loan over time. If the World Bank could take that loan and sell that loan to an investor who would then claim the cash flows of those payments from India, that's an example of a securitization. They take the loan, they package it, they resell it. Now, that's not entirely how it actually happens, and I'll talk about this in a second, but that's the idea. The other thing that policymakers are assuming is that private investors want access to debt that the multilateral development banks have de-risked, because this might be safer, the default rate might be low, the return profile might actually be quite good. And that's part of the reasoning here. So there are two mechanisms for how securitization generally works. The first one is called true sale securitization, where the multilateral development bank sells its loans, removing them entirely from the balance sheet of the multilateral, which is like that abstract India example that I just talked about. But realistically, what actually happens in these programs are proposals for what's called synthetic securitization, where the multilateral development bank buys something like a credit default swap on its loans. And that's a finance term. That's something that is traded very much on private financial assets, but that's the same idea that's actually happening here. The private investors in the transaction would give the multilateral development cash in exchange for the risk profile or just the stream of returns from the loan. Um, for example, if the African Development Bank is investing in a private sector solar project in a country like Ghana, um, and the African Development Bank wanted to sell off that loan in a synthetic securitization, it would sell the cash flows from the solar project, the returns the solar project has, to the private investors in return for the present value of the cash from those investments up front. That's pretty much how it works. Although contractually it gets very complex. The multilaterals prefer synthetic securitization. It's less complex than a direct asset sale, and it preserves, in theory, the multilateral development bank's oversight. And in a way, this credit default swap is a little bit like default insurance. If you get rid of the risk of the cash flow stream disappearing or defaulting, technically the credit rating agencies or for the lenders to the World Bank or the multilaterals, that actually increases the lending headroom of these institutions. So in the 2010s, the African Development Bank actually executed a synthetic securitization of $1 billion worth of its private loan portfolio. That's not really just loans to solar. These are loans to a lot of private businesses across sub-Saharan Africa. And according to the African Development Bank, by 2018, they had mobilized about $650 million in new lending. However, if you actually look into the design and structure of the transaction, there's a few issues with this. It wasn't easy to do. It took 4 years to get this process done. And it took $100 million of credit protection from a hedge fund. I think it was Meridian or Atlantic Capital that provided it. And that was the default swap. It's not clear how much that credit protection cost. The African Development Bank did not publish a figure for actually what that $100 million worth of upfront cash actually cost to them to secure. They also needed $100 million from the European Commission to guarantee another tranche of that 650 million in mobilized capital. So there's a lot more public money coming into this than initially assumed. And meanwhile, of the billion-dollar portfolio that they were trying to securitize, the AFDB retained about 750 million of it, which is actually a lot of the portfolio. The AFDB is not really reducing its lending headroom by too much. They can argue that they've gotten 650 million in new lending, and this is a pretty big achievement. But I will say that for taking 4 years, for providing for it costing an unknown sum for the hedge fund, for taking in more public money, this is not a very easy transaction under which you can actually mobilize private capital. So on the terms of policymakers' own goals to mobilize private capital, this was pretty complex and not really a success by any means, because we haven't seen anything like this happen again. It's been complex. Versions of it have happened in smaller cases, but these transactions don't get particularly easier. I showed a diagram. That's a diagram that Daniela Gabor made actually many, many years ago. It's a really good one. We're not going to get into it. I'll quickly end the securitization section by discussing this is all part of a larger principle called originate to distribute. Room to Run inspired a lot of aspects of the 2023-2024 World Bank reform agenda, where, in theory, what if the multilaterals made loans to private borrowers and then immediately sold them off to private lenders? That's originating a loan to distribute a loan. The theory is not really wrong. I think it makes sense for policymakers to want to figure out how to let the World Bank lend more. But a practice like securitization is time consuming, requires public guarantees, requires some public costs. And I think to that end, there's a little bit we don't know. And I think that's, it can be worrying. There are simpler ways to go about this. One of my suggestions about the world of securitization is that the multilaterals should actually be the buyers of other countries' loans and infrastructure assets to create a better standardized market. They should be the secondary market rather than trusting private lenders to create that secondary market for them. We can get into that in discussion, but in the meantime, I'm going to move on to insurance. So insurance markets are fun. There's a lot going on here that actually is complex, and a lot has changed over the past few years in the catastrophe insurance market. But I'll quickly give a breakdown of the three kinds of insurance that I think we ought to know for this school today. There's conventional insurance, which is the kind of insurance you more or less pay for your healthcare, for your house in the United States, especially for home insurance, where you pay your premiums into a pool every year. And you've got to do it in order to own the asset or get your healthcare, own your house. And if there is a disaster that meets a certain threshold, The insurance assessors come by and they assess the damages. The insurance company looks at your medical bills. Someone comes over to your house and assesses flood damage. The assessment takes time and valuation can be inaccurate. Especially across the global south, conventional insurance programs are harder to actually execute at a large scale because asset values are generally lower, assessment capacity is lower. The potential for a lot of market actors to pay premiums and get paid out with damages, it's a little tougher given the nature of informal markets, worse tax capacity, worse administrative capacity. So it's actually not exactly easy to demonstrate the success of like a conventional insurance program for climate risks in at least that's the theory here. So what policymakers have done instead is they've looked to two other instruments. One is called parametric insurance, one are called catastrophe bonds. Sometimes they're actually working the same way. Parametric insurance is just the insight that you can create an insurance mechanism where the payout for a disaster is tied to a climactic or event-based threshold, and you get the payout immediately if the event is a certain amount of damage, if the event reaches a certain damage threshold. The payout is faster, but they're independent of damage valuations entirely. You can get paid out, but it can have nothing to do with the amount that you were actually damaged by climate risk. And the trigger conditions can be manipulated. So that's another issue, just some of the playing around. Last but not least, there's catastrophe bonds, which, it's a reinsurance strategy for a lot of countries seeking to insure really large amounts, hundreds of billions of dollars worth of climate risk. It's basically taking parametric insurance and applying it to a whole economy. So Jamaica is a really big user
Sorry,
of.
Advait, that's 10 minutes. You've got a couple minutes left. Thank you. Sorry
Sure,
about that.
I'll make this really quick. One second. There's a noise in the background. All right, I'm back. My phone was ringing and I had to turn that off across the room. Okay, I'll talk about Jamaica's catastrophe bond really quickly. Jamaica got a catastrophe bond in 2024. It had about a 3-year term where Jamaica paid a bunch of cash to investors for, a high return rate. If every year a disaster didn't happen, the coupon on this bond was going to be pretty high, and investors would have gotten a great payout. However, Hurricane Melissa happened in October 25, triggered the notes, and Jamaica got $150 billion out of the catastrophe bond, which is pretty good. Well, I mean, that means it worked. I don't want to say it's pretty good because the damages of the actual hurricane were much larger than 150 million, but that's how the bond worked. So Jamaica's paying for protection, paying pretty good returns to hedge funds that want the bond, especially want that exposure, and is hoping that the payout that is faster than maybe a conventional insurance mechanism will help stabilize its economy. And, I'm not going to say it's a bad idea for Jamaica to ink deals like these, but it's also very clearly not enough to deal with the amount of disaster, the actual amount of disaster valuation that we know actually happened out of that hurricane. So there's a bunch of examples of different insurance mechanisms that I'll speed through just for time. There's parametric insurance programs in India. There have been scholars who have studied resilience funds and flood resilience in countries like Bangladesh, where, you can have insurance programs and community supports, but really what actually causes the problem is a much larger infrastructural challenge of dealing with climate change. Insurance is really a band-aid solution. Um, and of course, with catastrophe bonds, everyone is really into it. Everyone seems to think this is the right way for global South countries to treat their exposure. Investors love it because if catastrophes don't happen, you essentially have bonds where the returns are uncorrelated to any other asset on the market. That first article is from 2023. This one is actually from just 2 months ago, or maybe, yeah, earlier this year in 2026. The cat bond index has much higher returns than even the stock market. Not substantially higher, but higher enough that it's considered one of the best assets you can possibly have because the returns on a catastrophe bond are uncorrelated entirely to the existing market conditions elsewhere. So that's what makes them really good investments from the perspective of a hedge fund, if you're buying into that market. In the meantime, however, insurance losses keep getting more expensive. This is 3 years ago, the most expensive it's ever been. This is just a few months ago. Insurance losses continue to hit record highs, and the threat posed by what insurance companies called secondary perils also just keeps increasing. So there's something I wrote about a few years ago called the doom loop. It's just a way of understanding, I think, what insurance, how it really feeds into the system. Um, Basically, I'm making an argument about misallocated investment. Uh, in a world where we're measuring climate risk and a bunch of countries and cities can't get the resilience funding they need, they get more vulnerable on capital markets. Getting more vulnerable means you can't actually borrow on good terms to get the funding you need to build resilience. You lose resilience, you're more vulnerable, there's climate disasters, and all of a sudden, the disasters have you on the hook for paying out even more in damages and building more in resilience infrastructure. That makes you look worse on capital markets, so on and so forth. The doom loop is really just a situation where the lack of existing financing going towards vulnerable cities, communities, countries leads to exacerbated disaster risk. And insofar as insurance can't really deal with the climate challenge because climate is correlated, its risks are compounding, nowhere is really safe, and some places are less safe than others. There's a lot of reasons why these existing insurance mechanisms can be useful harm reduction levers, but they aren't exactly longer term solutions in and of themselves. That really requires a better program of public infrastructure finance that I think we've all been thinking through this past week. So Germany and the V20 put together this program called the Global Shield. I'm going to skip this. This is a good coordination instrument, but it doesn't really actually mobilize that much money. At least best as I can tell by the news, it's not a particularly serious initiative, at least from the perspective of mobilizing capital. I'll end by saying, institutional investment is not the end all be all of economic development. It's probably fine if you have private investors involved in developing projects or taking some, being part of a transaction. But in the ways that we've described in a lot of the mechanisms we've talked about this past week, I think policymakers are conflating measurements of private leverage in a transaction with the outcome. It's not simply a good thing if the private sector is investing or not. Are we actually getting the outcomes we need? Is the public sector getting growth? Is it getting development out of it? Are people getting delivered from climate risk issues? Are they getting better infrastructure out of the deal? That's usually no when we're talking about mobilizing private investment at the global level. So I'll end there. I'll end with this little slide about Goodhart's law, where I think policymakers' desire to measure the mobilization of private investment for long-term infrastructure ends up being the target that they've wanted to achieve. And when the measurement becomes a target, well, it ceases to become a good metric. So that's it for me. Please feel free to email me if you have any questions. But yeah, I'd love to talk more. And yeah, thanks a bunch.
Okay, I think I'm going to take over here, and thank you very much to both our speakers. And just a reminder for our participants to drop your questions in the chat box or the question and answer box. I don't see many questions just now. I know these are complicated topics, so maybe we can go back to some of the concepts and try to better unpack this, and that would probably encourage some of our participants to ask more questions. So maybe I start with the ones that are on the chat, and then also I think they're all directed to Miriam, and maybe just frame it a little bit broader as well. My understanding of your presentation is that all of these tools, like the taxonomies, the ESGs, are some sort of like assessment tools that label investments in a way that says to people that will invest, this is something that you can consider green or blue or socially focused, etc. And I think you've made it pretty clear that all of these are like industry standards. There are no actual regulations. And I think we're all interested in knowing if, despite the potential kind of issues with the instruments themselves, for example, you were explaining something that some of them are like taxonomies are principle based, some are more science based. So obviously there are differences in the quality of these instruments. But I think we're all kind of wondering whether the solution would be to have actually either like a legally binding framework, which I think you mentioned, or some sort of law that actually regulates these investments. Would that be the solution to the problem? And also, or do we need to, on top of that, have something that you also, I think, mentioned, which is the polluting taxonomy? Do we actually need more than just these green, blue, and so on? Do we need something binding that actually says, no, you cannot invest on this and that, like an exclusion list, I think you said it, because these things are harmful socially, environmentally, for the climate, etc. So maybe I'll start with that one.
Yeah.
And I think that sort of links to one of the questions that were on the chat.
Yeah, I think there are two issues on the regulation, in the sense that some of them, like for instance the taxonomies, some of them are like in the European Union. There's a law that said this is a taxonomy, and then the issue is what is in the taxonomy. And there it's like, how strict are the definitions? How much are they science-based? How much are they kind of really very prescriptive, so you can't do any greenwashing? So that's one thing. You have like a rule that says, what is the definition? The problem is that there is no obligation to use that in your instruments. So for instance, you can have huge amounts of green bonds which are not using the taxonomy and therefore the green. There's actually a law to say if you want to say it's a EU green bond, you have to use a taxonomy, but that's not what is happening. So it's the industry-led green bond principles that are being used, and those are much, much weaker. So there's like two issues. Yes, the law, but the law has to be about application. And the current application is only about you have to say how much of your activities as a company or as a bank is according to the taxonomy. But it's only reporting. So a lot of these things are about reporting, about disclosure, and supposedly investors have then to know that they are risky. That's why I'm saying in the beginning, it's about the risk that climate might have. And I wanted to go back to what Advent just said, because the insurance industry themselves, in order to pay out, they not only get premiums, they are also investing huge amounts of money all over the place, including in fossil fuels, because they have high returns. Yeah. So there is a law on insurance industry, which is trying now in the European Union, and I think in some other countries and also at the international level, to see how you can at least avoid that the insurance industry is not themselves by their investments kind of contributing to especially in having problems that their bonds and their shares that they're investing in will go down. So it's about, how do you apply it to those who are financing, and how do you apply it also to companies? And that's not happening for the moment. So yes, that's why I think it's very important. And of course, and the content and making sure how then the process is going of how you define it, because of course it's a huge lobbying carousel, which is, I've witnessed it also in Asian countries. And that's a real problem as well. So I hope that helps a little bit too. And then on the dirty one, yes, I think it's really, really important, first of all, to have a list to say it's prohibited to finance this, even if you do it in a phase-out way. And to make sure that, that it is very clear and that it is being applied as well. Because otherwise, basically what you have now is, that's why you have the problem of this net zero. Because net means that on the one hand, you have more green financing, and on the other hand, you have the dirty financing, and there should be kind of getting until zero change in emissions. But that doesn't mean you reduce the emissions, and that's the current problem.
Thank you very much for those clarifications and for making it a lot clearer. I have now a question for Advait, so maybe I'll move to that one. The question in the chat is whether the MDB loan is like as you were explaining securitization, no, the MDB loans are sold off to private investors. And the clarification is, do they actually get the rewards from it? So basically the profits. I think you sort of explained that for a synthetic securitization, that was the case, but maybe you can clarify that as well. And if so, isn't that like an issue for the MDBs as well in the long-term model, since they're not getting those cash flows? So yeah, I think if you can clarify whether that in the long term that actually also is an issue for the long-term model of the MDBs.
Yeah, so the answer is yes, that the loan is like the profits of the loan are being put into an escrow account that is being remitted to a private investor. Like that's the actual legal structure of the process. You would just move all the cash the MDB would be getting to an account that the private sector could access. And in return, the private sector puts cash into that account that the MDB can access upfront. And I guess the idea is you're trading what is basically a long-term flow of cash that maybe will stick around and maybe will disappear for just that upfront injection of cash that you can use immediately towards deploying a new loan or backing a new loan to something new that generates more cash. I think it's actually not clear if it is if that particular transfer of long-term cash flows for upfront cash is a problem for long-term MDB functioning. I think it might be insofar as there's issues with how you value infrastructure projects. There's issues with how you value MDB's loans to whether private or public borrowers. And if private firms are undervaluing that or treat those loans as illiquid or risky, very clearly for room to run, we saw public guarantees play a big part of how that transaction even made it through. It's possible the private sector is not going to be putting that much cash in return for the cash flow stream that they're receiving from the synthetic securitization. And assuming the process rinses and repeats and becomes something more standardized, which it might not, it might be bespoke and we might not see it that often. But if it does, and if the multilaterals are consistently getting less cash than they probably should be for these kinds of assets, then it's possible that over time, securitization does actually undercut the multilateral development banks' balance sheets. I don't think it's wrong in principle to be getting cash up front, to be putting out more loans. And if that's a thing that you can do at fair valuations, then I think that makes sense, because then you actually can get more projects out the door faster. But I've never been particularly convinced that private sector investors, especially the longer term ones, are valuing public infrastructure particularly well. They usually don't. It's usually something that they value better when the market's doing good and value badly otherwise. And I think that kind of uncertainty makes it tougher for MDBs to make that securitization market work for them too in the medium term. So hopefully that gives you better context. It's not a question we have a straight answer to, but that's sort of what I think about.
Thanks so much. Miriam, did you want to come in? Yeah.
Yeah, there's two things. First of all, securitization also happened by the private sector. So the banks are also doing that. And I think probably on the synthetic securitization, there is an issue where actually what is happening is it's only giving the credit default swaps are actually only an insurance. So in case it's not being repaid, then there will be this payment by the investors, and the investors are only paying, and then the banks or the MDBs are only paying a fee to those investors as a kind of a premium. So that's one thing. So I think that's an important issue, that to see that it will be very much less visible how much climate risks the banks and the investors and so on have, and it's being spread around the financial sector in this sense. So it's called dispersing the risk, but the risk is still there. And that makes it kind of, if there's going to be a crisis, a very quick climate crisis, the whole system will be interconnected, and these things, people will know what is happening. And then that's where you have a financial crisis.
Yes, thank you so much for that addition. I have a question for you on the links to the UN Tax Convention, if you see any linkages between the current discussions and the taxonomies. And I also want to add a question to Advait about the doom loop. I thought it was quite a good thing that you showed. And moving a little bit beyond what we're discussing about, specifically on insurance, I wanted to kind of ask a more broad question to both of you, actually, if this idea of this climate risk doom loop could also be a good starting point to having conversations more on the side of reparations and loss and damage finance and so on, because I think it's a great illustration to see how all of these are related.
On the tax issue, first of all, I want to say, for me, kind of, if you talk about ESG, and the G is governance, and it is very important that if ever you're engaged, that tax dodging is part of it, actually also the lobbying. And that's not always the case, unfortunately. But in some of the reporting standards, it's there. I think it's important. I think what would be very important, if indeed we have, if it would work and the governments would have much more money themselves, which kind of to be able to pay for infrastructure and whatever. At least I think some of the taxonomies are strict enough that they know where to put the money, to have very clear descriptions, so kind of the bankability or whatever, so that you have a definition. Because in the global south, some of the governments are linking, for instance, their taxonomy that they have defined themselves on what, if you want to have a subsidy, you have to align with these things. And that would be the same if they would then be having more money for their own infrastructure, kind of that they would have. But that's kind of very indirect links. And I think on the doom loop, it's the same with the banks. I mean, the banks are financing their own risk in the long term. It's just incredible.
So I'll
Yeah,
quickly
it's
jump in and discuss the doom loop question. I think it is a really good way to think more about loss and damage reparations, or even just like a better public finance ecosystem that provides liquidity to essential projects over the long term. I mean, if we know that insurance mechanisms as they are stopgaps, and I know we didn't talk about Global Shield, but similarly, programs like that exist in the insurance space are designed to mobilize private capital or philanthropic capital towards de-risking the creation of insurance markets in the global south. At some point, there's only really a limited amount that those can do to avoid that question of simply the damage amounts will be higher than the insurance payouts will be, the assessments won't be good, this is going to be a compounding climate crisis at any rate. All of these kinds of factors and the inadequacy of an insurance program, even conceptually, sort of lead me to think that yes, absolutely, this is a good reason to think about something bigger, something you can push for in the realm of whether, there is a loss and damage fund. Obviously, it's very small, not very adequate. And there are discussions about making the actual multilaterals better suited towards financing infrastructure over the long term in ways that have nothing to do with insurance and are much longer duration in ways that are, I think, safer than these kinds of mechanisms. I think that's much more worth pushing for.
Thank you. I have another question for both of you. I think, and it's coming from the chat, but I want to reframe it a little bit. We talked about, I think, at the beginning with the taxonomies and ESGs about the idea of a binding framework or the possibility of a binding framework. And it's interesting because someone has raised the Paris Agreement and Article 2, and I guess specifically Article 2.1c of the Paris Agreement, which talks about making finance flows consistent with a pathway, towards low emissions and climate resilient development. That in and of itself, in an understanding, is a binding framework, even though it is obviously not clearly defined to be binding enough for this specific purpose, but it is a framework that is in itself binding. And what is your take on the possibility of these conversations to actually regulate the investment behavior and go into like what we were discussing about the exclusion list, the no brown investment, and making that legally binding? I think that would be and regulating also all of the other things that we've been discussing here.
Yeah, I mean, I completely agree. I mean, basically, that is the idea, and that should be the obligation. But what you see in the discussions at the COP is that it's especially about the public finance, and there is nothing about the private finance. And that's where it's extremely worrying because it's really the private sector financing that goes and finances the fossil fuels and etc. and the companies, etc. So that's why in my talk I was also mentioning the other actors, which are really the ones who are taking decisions, even if it's only international standards. I mean, the Basel Committee on Banking Supervision is they have a working group on finance, and it's now the US is blocking, it's on green finance. And, what the banks should do to at least to de-risk themselves, to make sure that there's no climate risk and that they orient their financing in another way. The same with the investment industry. So the IOSCO is the International Organization of Securities Commissions. So a lot of people from a lot of financial market authorities from the global south are participating there. And of course, they don't always have the means to participate into it, etc. But they are at least trying to set a few international standards. Of course, they're hugely lobbied as well. I mean, at some conference, I was like the only non-profit, while all the other ones were from the financial sector. Because that's where at least the standards are set. And the importance there is that these standards are very often kind of really the ones that are being transposed in one way or another at the national level. So that's where kind of the members have a bit of an obligation to implement it in their laws. Yeah. So that's why these are very important organizations where civil society has very little, sometimes attention, sometimes input. But that's where I think it's an important issue where And I don't know whether and how far we at the COP. I mean, I'm trying with that's one of my links, when I was giving comments, like, why these trillions of dollars are undermining what is being said at the COP, and whether at the COP we really need to have much more influence on private sector. But I think to kind of really go down much more concretely, you might have to go to the other ones. But it's very worrying that the financial private sector is absolutely able to not. Well, actually, it was very interesting in 2021. They had all this, yeah, we will finance it, and they had all these instruments, and then no. Most of the banks and the investment industry people, I mean, companies have withdrawn from any commitment. I mean, voluntary commitment. That's the thing. They're really withdrawn from any commitment to continue. And the mantra that you hear now and then, and that's also why the COP is now not dealing with them. I don't know what is happening this year because it's focusing on finance, but the mantra is, oh, we can only follow the economy. We can only, it's the economy, the others who have to change, and then we will follow. While like 4 or 5 years ago, they would say, oh, we have this financing, we can do it, and whatever. So it's very worrying.
Yes, thanks. Absolutely. I totally agree with you. I see that Rebecca has shared the survey on the chat, so please, in the meantime, before we wrap up, if you have time to look at the survey, please do. Any final comments on that question? If not, then I think we have gone through most of the questions, and I will give it then back to Rebecca for some final words before we close.
Yeah, thanks a lot, Berta. And I see we're at time, so I won't be long, but I just want to thanks again Advait, Miriam, for this great presentation. And a lot of concepts were shared, but they really took time also to walk us through, give example, come back to them. So I think that was really what we were hoping for this last session of the school. Thank you so much, Berta and Alia, also for a great moderation. Thanks for all the participants. You were, again, very numerous today, so it's showing a real interest and appetite. So I'm really thankful for that as well. Flagging that the survey and the recording are in the chat. The survey and the toolkit with the recordings are in the chat, so feel free to use it. That's definitely there for you to continue to learn, to read, etc., but also to tell us what you would like to see next. So please use that space as well. Thank you all. Have a good rest of your day, afternoon, evening, and I hope to see you all soon. Bye-bye.
Thank you so much.